Hi everyone, this is Jadu from Property Frameworks Buyers Agency, and today I want to talk about the 7 things that you should do when investing in property. Number one, always have a goal in place. This goal could be a passive income target. For example, you want to achieve a passive income of $100,000 within the next 15 to 20 years, or it could be to buy a dream home where you want to use equity from the investment properties or sell off the investment properties to buy your dream home. So, whatever it is, always make sure that you have a goal in place. Number two, have a plan or a strategy to reach that goal. So, this is where you actually go into the details and determine what type of properties you're buying, which areas you're buying, what is the growth rate of that property, what is the rental yield you're getting, what are your income and expenses today, and what are they going to be in the future, what is your borrowing capacity, and just things like that you need to consider. You would also maybe need to consider whether you want to buy the property in your own name or under certain trust structures, for example. So different things to consider when you build that strategy or a plan to reach that goal. Okay. Now, number three, always buy in established suburbs. An established suburb is a suburb that has been built out. There's no more properties coming into this suburb. It's completely different from a growth suburb. A growth suburb is one where new properties are coming in for the next few years. There are going to be more properties coming over the next few years. So that's a growth suburb. We don't want to be buying in a growth suburb. We want to be buying in an established suburb where there's limited new stock and there's healthy demand from owner occupiers and investors, so that the price pressure is always there. So always buy in established suburbs. The next one is look for high land to asset ratios. Now, the absolute basic in property investing is that the land is the one that increases in value, the house depreciates in value. So you want something with a higher land to asset ratio. When I say higher land to asset ratio, this means the land is the one that has the higher proportion of the value as compared to the total value of the property. You want to target around 70% land to asset ratio. For example, if the property is worth 1 million, you want the land value to be about 700,000. So the higher the land value is, the better that is for your property. The next one is healthy capital growth and healthy rental yields. Now, there is this myth that you can't achieve both capital growth and rental yields, but that's not true. You could still buy in good capital growth areas and still have healthy yields. Target about 5% capital growth, and that's being very conservative, and that's very achievable as well. And then determine what rental yield you need. To determine the rental yield, try to find out how much cash flow that you can sustain to go out of your pocket in the worst case scenario, and then find out what rental yield you need to match that cash flow profile. And once you have that, you know your ideal rental yield, and that's the bare minimum that you can manage. So anything above that figure is going to be healthy for you. So good capital growth and check your yield. Next one is treating investment like a business. So this is where you want to look at your investment property or properties and try to see how you can increase your rents, how you can reduce expenses, how you can increase your borrowing capacity. What do you need to do to buy more properties? What do you need to do to buy more properties at a profit? And so you're looking at the whole thing like a business. Okay, so that's point number 6. And the last one is de-risking your investments. Now, let's say you bought a property in an area and the worst case scenario, the market doesn't do anything for many years. So to de-risk your investment, what you could do is you could put in a couple of other strategies in place. For example, you could find a property where you could add value. So when I say add value, this means you're doing some kind of renovation, for example, a cosmetic renovation, and forcing value onto that property. Or you could look for a property with development potential so that you could knock down the house, for example, and build a few properties there. So in case the market doesn't do the heavy lifting, you have some other strategies in place so that you can de-risk your investment. So those are 7 points that I wanted to share today. Hope you found that useful. Thank you.